everyone, welcome. Let's just dive right into this explainer because today we are taking a really fascinating look under the hood of the ultimate architect of India's economy. I'm talking about the Reserve Bank of India. We're going to decode exactly how this massive institution operates and, maybe more importantly, how its top-level decisions actually ripple all the way down to impact your personal finances.
Think about it. Who really controls the money in your bank? It's a simple question, right? You might instinctively think it's your local branch manager, or maybe the CEO of your specific bank, but the reality is way more complex. There's this vast, highly structured nervous system overseeing literally every single rupee and setting the stage for every financial move you make.
So to break this all down, here's our roadmap for today. First, we'll look at the core of the RBI. Then, its regional and local reach. Third, we'll cover building financial expertise. Fourth, understanding teaser loans. And finally, protecting your bank deposits.
All right, Section 1, the core of the RBI, inside the central brain.
Now, to help us wrap our heads around this, we'll be looking at some frameworks sourced directly from Study IQ IAS. Their rigorous approach really gives us the perfect structural view of this whole banking system.
What's absolutely wild here is the sheer level of scrutiny involved in picking the leader of this institution. I mean, under Section 8(1)(a) of the Reserve Bank of India Act of 1934, appointing the RBI governor isn't just a regular corporate hire. It's a matter of profound national economic security. It's a very strict three-step process. First up, the Financial Sector Regulatory Appointment Search Committee, which includes heavy hitters like the Cabinet Secretary, interviews the candidates. Then, the Union Finance Minister makes a recommendation. And finally, the Prime Minister's office formally makes the appointment. It's a highly vetted process, perfectly designed to put the most qualified hands on the economic steering wheel.
But here's the thing, the governor doesn't run the show all by themselves. The affairs of the RBI are governed by a central board of directors, and it's basically a masterclass in the balance of power. You have your official full-time directors, that's the governor and up to 4 deputy governors. But then you have the non-official directors. This group includes 10 people nominated from various fields, 2 government officials, and 4 directors representing local boards. And those nominated and local members serve 4-year terms. So it's this precisely constructed mix of internal banking experts and completely external, diverse perspectives.
Moving on to Section 2, regional and local reach, grassroots representation.
Look, India is huge. It's incredibly diverse, both economically and geographically. A single boardroom in Mumbai or Delhi just can't possibly keep tabs on everything. So, the RBI spreads its reach out, using local boards constituted for 4 distinct regions: the western, eastern, northern, and southern areas. Each of these 4 boards has 5 members. They're all appointed by the central government, and they hold office for a 4-year term.
So what do these folks actually do? Well, they're basically the ultimate feedback loop. Their main job is to advise the central board on local matters and to really represent the territorial and economic interests of local cooperative and indigenous banks. They make absolutely sure that the grassroots economic realities out in the furthest corners of India aren't just ignored by the central blueprint.
Which brings us to Section 3, building financial expertise, training and institutes.
Now, how does an institution this massive stay sharp and technologically ahead of the curve? Well, the RBI isn't just a building full of bankers in suits. It's an entire hub for tech innovators and researchers. It operates several crucial training establishments. Some are directly part of the Reserve Bank, like the RBI Academy, the College of Agricultural Banking, and the RBI Staff College. But it also leans on autonomous tech-driven bodies, like the Institute for Development and Research in Banking Technology, or IDRBT, to completely push the boundaries of what modern banking tech can do.
And the scale of this whole ecosystem is just staggering. The RBI fully funds advanced research centers like CAFRL and IGIDR to deeply understand market dynamics. It sponsors vital national infrastructure too. We're talking everything from physically printing our bank notes with BRBNMPL to securing our vast IT networks with Ribbit and IFTS, and even driving future breakthroughs through the RBI Innovation Hub. It is a sprawling, totally proactive network of research and economic security.
All right, Section 4, understanding teaser loans, consumer finance impact.
Now we're getting into the stuff that directly hits your wallet. Let's pivot to the actual financial products the RBI monitors. You have definitely seen advertisements for these. A teaser loan is pretty much exactly what it sounds like. It's any loan offering a significantly lower interest rate for a fixed initial amount of time as a purchase incentive. They're super common for big-ticket everyday things, personal loans, home loans, car loans. They essentially tease you in with affordability.
But here is exactly where the RBI and regulators get really cautious. Look at the 2 phases of a teaser loan.
In the initial phase, you get these ultra-low fixed rates. It feels totally manageable, right? But in the later phase, those rates suddenly flip to become market-linked, meaning your predictable, low monthly payment can absolutely skyrocket. Because these loans often attract borrowers with lower credit ratings who are drawn in by that low initial cost, they're widely considered a pretty risky aspect of subprime lending.
So how do banks manage that risk? They need to know exactly who they're dealing with. Enter the Public Credit Registry. This is an extensive database packed with borrower credit information, and it's accessible to all lending institutions. It involves 4 private credit information companies plus major central data repositories tracking large credits. This whole system is how banks know exactly how much risk you carry before they ever approve that teaser loan.
And that brings us to our final stop, Section 5, Protecting Your Bank Deposits, Insurance and DICGC.
This is honestly the highest stakes part of our whole explainer. What actually happens to your deposited money in a crisis? Well, to understand the protections we have today, we have to look back at the panic of the past. The whole idea of insuring bank deposits got serious attention in India after 2 massive crashes in 1960, the Pale Central Bank and the Lakshmi Bank. People literally lost their life savings. The public outcry completely shook the system, and that direct crisis led to the Deposit Insurance Act in 1961. Fast forward to modern times, and the system needed another huge update in 2021 to handle new types of banking restrictions.
The organization born from that 1961 act is the DICGC, the Deposit Insurance and Credit Guarantee Corporation. They are legally bound to pay depositors their insured money. But when does that actually happen? They step in during some highly stressful scenarios. If an insured bank undergoes liquidation, which means it just completely closes down and sells off its assets, or if it goes through a major reconstruction scheme, or if it's forced into a merger or acquisition by another healthier bank.
But, for years there was this massive loophole. Sometimes, instead of liquidating a bank, the RBI simply places a moratorium on it, basically freezing operations to stop a bank run. The problem with that? Genuine depositors were totally locked out of accessing their own insured money during these freezes. It was a nightmare. So the solution was the 2021 DICG Amendment Act. It was passed specifically to ensure that even if your bank is placed under a moratorium, you can still access your insured deposit amount. It was a huge win for everyday consumer security.
Which leaves us with a pretty big question. We've just mapped out the incredible complex architecture of the Reserve Bank of India, from the governor's seat all the way down to your personal deposit insurance. But as banking continues to rapidly evolve with new technologies, digital currencies, and global interconnectedness, how prepared is our central bank to protect against the next great financial crisis? It is definitely a question worth asking, and one the RBI is undoubtedly trying to answer every single day. Thanks so much for joining me on this explainer. Until next time, stay curious and keep learning.